Good afternoon, everybody. This is Andrew Wilkinson coming to you from a very snowed-in New York state. And it's a pleasure to have with me today Joel Fingerman from Fundamental Analytics. I'm just going to put up a couple of disclosures here from the Interactive Brokers perspective. I'll leave those on the screen for you to digest for a moment. And then in a second, I'm going to hand over to Joel Fingerman of Fundamental Analytics, where he is the managing partner, and he's going to walk us through the tool that is available through Interactive Brokers Trader Workstation. And there's some disclosures there from Joel. So Joel, welcome. I'm going to make you the presenter. One second to do that. Okay, Joel, if you can share your screen. Welcome to today's session.
Thank you, Andrew.
I'm going to hand over to you. Just before I do, if you have any questions throughout the session, please put them into the question bank, and Joel and I will discuss those after his presentation. So we'd appreciate a bit of patience from you. If you want a copy of today's presentation, please email me at webinars@interactivebrokers.com, and I'll send you the deck that Joel has prepared, although he is going to take us through the website and the analytics and what you can access as a subscriber to the service. And I think, Joel, you're also going to talk about DOE numbers that came out, and you were showing me earlier some statistics that you aggregate and put into a nice document. And I think those are available for email from Joel at joel.fingerman@fundamentalanalytics.com. And Joel, you can address that throughout your presentation. So Joel, I'm going to go on mute, and it's over to you.
Well, thank you, Andrew. I appreciate it. Good afternoon, everyone. And what we'll talk about today is energy issues. As you see in our landing page for our platform, we actually view other commodities, but the main area that I've worked in for many, many years, and I'm based in Chicago, is energy. And the reason agriculture is also part of it is my office is near the Board of Trade in Chicago, where there's these grain traders who asked if we could put something up equivalent for grains and agriculture to energy, so we did, and expanded out to financials and metals. But today we'll discuss specifically energy issues. Now, when you click on this icon, you get the choices of the commodities we cover. I'll start with the discussion of crude oil from the data that we have, the way we look at it, and so on, because earlier this morning, the Department of Energy through the EIA released the latest data supply-demand values for crude oil and refined products, and therefore we can discuss it and look at the general setting and where we are right now, looking forward to the rest of the year and what the data may suggest for the rest of the year. We have three areas of interest in our system. We default to prices. I would click here to select crude oil, which I'll be discussing. And then fundamentals means supply-demand issues relative to prices of crude oil. And then thirdly, we have analysis. Now, analysis what I want to tell you what it does not mean. It does not mean technical analysis in terms of support, resistance, retracements, Fibonacci numbers, stochastic measures, and so on. This analysis in our system is merging of fundamental data with price data to see what fundamental factors may or may not affect prices. It's the merging of the two is what we call analysis. And again, I will come back to that in the course of this discussion. Let me click now on fundamentals. We'll start with this and then go to pricing. And I'll select, as you see here, there are sources of fundamental data ranging from the American Petroleum Institute API data, Baker Hughes, the rig counts, CFTC, which is a commitment of traders data, and so on. And since this morning, the DOE numbers, excuse me, were just released an hour and a half ago, I'll go here and choose crude oil. Notice our system, as far as navigation, doesn't require you to know any symbols or codes or systems. You just follow the select choices, and it just guides you through this. So I'm going to look at stocks, the inventory of crude oil. That's what people watch when they first come out. And we'll look at commercial, and then we can select it by region of the country, or we could do Cushing, Oklahoma, which is the delivery point for the WTI contract, but I'll go to total US. Once it's completed all the selections, you get the interval of time. This is weekly data, and we click on plot the data. And what pops up is a year-on-year overlay chart of the crude oil stocks. The most recent value, which was announced, released this morning, was for the week ending Friday, the 29th of January 2021, where it says the last value, or the current value, is 475 million barrels, and it was a change of a drop of roughly 994,000 barrels, or about a million barrel drop from the previous week ending on the 22nd. It also shows you what the 5-year average is and other data. And to also point out that as you sweep across this, you can find other days and points of data at any point on the chart. It also, in this case, is defaulting to last 10 years worth of data. One can adjust this to their own particular needs, whether they want fewer data or more. At this point, the default is at 10 years. Again, from a navigation point of view, if I point to a legend, it highlights that year's data. And if I wanted to remove the data from the screen to view specific or fewer years, I do it and it adjusts accordingly. If I click on Show All Series, it brings the data back. And on the flip side of this, if I just wanted to focus on one particular year, such as the few weeks we've had so far, I'm holding the Control key down on my keyboard, and I point to the legend for 2021 and left click, and it just isolates that. So if I wanted to compare this year with something for whatever reason to 2015, I would click that, and I can bring data back in that I want to see relative to whatever. So you have this choice of manipulating the data that you might want to see. Also, since this is a default as a chart, we have the choice to create a time series of this data. And I click on that, and we see the time series going back to, again, January of 2011 and the current values. So we had peaked, it's more pronounced this way to see we had peaked in 2020 and have been coming off with the latest data as we are. Speaking of the data, it's often asked of us, can we see these numbers? And you click on the data and you see it as a kind of spreadsheet format. I'm going to reverse the order for a moment here. And now, again, the latest value is that 475,659, which was a drop of 994,000 barrels, which shows what was in last year, the 5-year average, and the 5-year average change. We're also asked if they can get this data themselves, and indeed, you have an opportunity, anything that you're looking at, to drop into an Excel spreadsheet to work on it and view it on your own. But again, it's just a toggle switch back and forth between the between the data itself and the chart. Now, if I were looking at this on a regular basis and didn't want to go through the steps, I can do a couple of things here. First, I'll click on this to edit the title. The default was the fundamentals. And so I'll call this Total Crude Oil Stocks. And then if I wanted to have this save, so to speak, in my library under my password, I click on Save, and it shows me where it came from, its fundamental data. It shows me what we call the breadcrumbs, the steps to get that, and the title that we've assigned it. And you have other fields of defining the information, because if you have a whole set of crude oil information, a whole set of gasoline or natural gas information, you can then organize it by the whatever measures you want to use. One other point I want to make here, excuse me, let me take a little sip of water. One of the things I want to point out here is the default show box. If I were to tick that box, what that means is every time I log into the platform and I open it up, this chart will automatically be pulled up and updated to the latest data. So you don't even have to go through the steps. You can save it in the library and then pull it from the library manually, or you can put this default show box ticked, which automatically brings it up whenever you log into the system. Okay, now the other thing I can do is then duplicate this by clicking on this box and slipping over here. We were looking at the stocks. What's been of a great deal of interest is the U.S. production of crude oil. So I click on that, follow through, I'll do total U.S., and I'll plot the data. Now again, I would prefer to see it as a time series. The default is a year-on-year overlay. And this is, again, the production, U.S. domestic production of crude oil. And we see that it had peaked here back in, where was this? Early 2020 at 13 million barrels a day in production. This has to do with the increase in fracking and other sources of crude oil. I want to also point out that these are not bad data points where it drops like this dramatically, but those are hurricanes in the Gulf of Mexico, where the great amount of offshore platforms and right along the coast there, onshore drilling. When you have a large hurricane like that, they will evacuate the platforms, they will cut down the production operations, and so you have this drop briefly, and then it comes back. Excuse me again, I apologize for this, my allergies. And we've seen this last summer, there were other issues that were going on. We also see the effect, so to speak, of COVID, because when the lockdown occurred in March of 2020 in the U.S., you had all these people who normally would commute to work, driving to work, suddenly were staying home. And one statistic that's been used is in the U.S., 80% of gasoline consumption is based on commuting to work. So if you cut all that off temporarily or even permanently, what that means is you need less crude to make the gasoline and other refined products, and so the production values just collapse, also in part because the prices had collapsed at the time. I will do, now again, I could name this. So this is my total crude oil production. And what will happen as we go through these demonstration, we'll get a series of these tabs created, and this is what we call a dashboard. And you can have them all saved, brought them up automatically, and you'll have a whole collection of tabs across the screen describing the information that you're looking for, or listing the information that you look at regularly. I was talking to one of our clients who do a lot of what they call calendar spread trading, and when they populate, it takes about 50 tabs that they bring up when they initially open up the platform. And I say, do you go out for a cup of coffee at that point? And he says, yeah, we have to wait a bit because it is a whole lot. But there is just, you create this tablet dashboard of information with all these tabs that are named and saved. All right, I'm going to duplicate this and switch over. I can't even spell production correctly. I'll switch over to exports. And the reason we're bringing this up is there was a change in the U.S. law in 2015. Prior to that, since the 70s, domestically produced crude oil could not be exported for national security reasons, but that law was changed in 2015. So prior to that, we see very low exports of domestically produced crude oil. And I can squeeze this in. to focus in on our exports. And we see that exports had gone from roughly 500,000 barrels a day to as much as almost 4.5 million barrels a day. And it's again come off in part due to COVID, but we are increasing a bit on the exports. And there is expectation that in the next few years, the U.S. will be one of the swing players in terms of supplying the world by exporting domestically produced crude oil this way. Now, I started off looking at crude oil stocks. And when the numbers come out in the morning at 9:30 Central Time in the U.S., the three biggies, so to speak, are the crude oil, and then the gasoline stocks, and the distillate stocks. So I'm going to bring up gasoline for the moment. And get total motor gasoline, total US, and we plot the data. And this, you see, the inventories on gasoline are much more seasonal because of the summer driving and then the winter lows, fall and winter lows. Again, I can switch to the time series and you see the cycling of the inventories of gasoline as responding to demand. And we also see that, if I go back to the chart, that it peaks basically in February. And the reason is the refiners know that they have to get a kind of a run on it before there's concern in the summertime in the U.S. driving for all the vacationers and so on. So it tends to peak there, then come off. Now we see last year, the red line, it did not fall off for the reason back in March of 2020, when the country closed down basically, the need for gasoline also just collapsed. So the refiners were still operating and producing the gasoline, but it wasn't being purchased or used by the commercial public. And so therefore we had this inventory pop, which we've been working off, and at this point have a little more reasonable seasonal values as we go along. Now I'll switch to the time series. And we see again, where normally this would have come off and stayed off, it popped back up, and we're seeing the seasonality come back into the gasoline. And again, I could rename this gasoline stocks and have a series of tabs with all the individual names. I'll duplicate this, go back to the fundamentals, and I should remind you, this mid-tab here is kind of an important way of going back and forth from the chart or data that you're looking at and seeing the steps that were used, what we call the parameter estimates that were used to create the chart. We go back here, we're talking about stocks of gasoline. We can switch now to stocks of distillates. Well, I have to switch from gasoline to the distillate fuel. Stocks. Total. And there we have our year-on-year overlay chart of the distillate stocks. There used to be a much more pronounced seasonality with the winter heating and the summer not needed, but now diesel and heating oils are used primarily for transportation, commercial transportation, so we see less of the seasonality. But again, last summer, we had the issue where everything was closing down, and the demand, especially for jet fuel, which is part of the distillates fuel pool, jet fuel was virtually reduced by 70–80% use, so that as part of the distillate fuel pool of all those products, those middle distillate products, we saw that we had an oversupply at that time because of that. They've been working it off in part because the refiners have cut back on production of these things, but we do see we're still not completely out of the woods, so there's going to be issues of it, despite the fact that we're seeing some good progress in pricing. I'm going to switch here back again to time series, and unlike the gasoline, we don't have the strong seasonality there used to be, but it's now more of a commercial issue for driving and transportation and less so for winter heating. All right, I'll come back to those momentarily. But let's talk about prices for a moment, because we want to have a sense of right now the fundamentals are adjusting to normal. I apologize for this, my coughing and through these allergies. But let's talk about the price of crude oil. And we have that as the default. I would select the chart. We can look at just the daily price table. Plot that. And it shows us all the contracts. So the March crude oil contract yesterday settled at $54.76. The April contract settled at $54.62, and so on. So we are moving into what we call a backwardated market, stronger backwardated market. And I'll duplicate this and switch over. One of the things I like to look at to understand the market is the forward curve. So we remember the March contract at 54.76 was kind of the highest value. It decreased here 14 cents and so on, down to out into May of 2022 is at 50.39 are the prices. It's not a forecast. It's what refiners, hedgers are willing to pay for that crude in those months coming forward. I plot the data, and there we see the forward curve, which we call in backwardation. When prices get very low, this tends to go into contango, and I'll come back to that notion. One of the things our platform offers us, I'll click Add Position. I'll again bring up the crude oil. And the default was yesterday's settle. I will say, well, where was it a month ago? Beginning of January. Say 5th. Plot that data, and we see the curve there. And I'll brag here for a moment to say I don't know of a system which is nearly as easy or as fast as our system is for bringing up data and to visualize it. So here is the current market, where yesterday's settle was at 54.76. A month earlier, it had been around $50, and it's been moving up, and at the same time, the backwardation is steepening. It's this notion backwardated. This is unusual in commodity markets. Most commodity markets do not operate where the deferred contracts, the further out you go on the curve, are at lower prices. Almost all of them are at higher prices because one has to adjust for the cost of money and the cost of storage. In the oil market, since its refineries are running 24/7, they need the crude all the time. If there's a concern that there might be a shortage because of demand or the lack of production, then the curve becomes backwardated as they're bidding up the front of the curve because they're more concerned about making sure this particular month we're going to satisfy the refiner's needs and not later is concerned. Now, they're starting at different levels and different prices, but what we can do also here is to compare them under a structural basis, where I click cumulative return, which is on a percent change. So it's showing again that here the current forward curve is steeper than it was a month ago because of this increasing demand and higher prices. So it's bidding up the front, and we have a steeper backwardated market. I'll duplicate this, go to my next tab. Oh, just to point out, for completeness, we have a high-low plotting data, high-low close plotting with candlestick charts, and it's just not that it's a key ingredient of our work, the way we do it, but we have, by client's request, added that. And again, from client requests, we've added, if you want to plot the Bollinger Bands. as part of it. And there has been talk in the technical press that recently now the prices have moved above the upper band of the Bollinger Band and maybe meaning a possible retracement. I'll click this to create another tab and another choice. We've gone through forward curves. Let's jump down here to instruments and spreads, which is one of the more popular devices we have. It defaults to what we call the front month contract. The March contract is now the front month for the crude oil prices. I click plot data. And notice too that the method of navigation does not change no matter where you are on the platform. If you understand how to manipulate here, you can do it anywhere else. So this is a year-on-year chart now of prices with what we call the forwards. So the front month, so to speak, is the 2021 contract, but in its price, and again, I'm holding the control key down and I left click on that, and it just shows me what this particular March contract has been doing since a year back. So it's rising to new highs. And if I then wanted to compare it with 2, 3, 4 years ago, click 2017 or fill it in back. This way showing the so-called strength of the market and possibly some seasonality that we might find underlying that. And I could switch contracts to a more deferred contract. I could look at the December contract. I'll duplicate this. And switch to December. Important pricing month for crude oil traders. There's your December contract with expiration around November 20th. And so this is again, the front month, holding a control key, focusing on 2021 contract, and then backing in with the others. We see where it is relative to other years and the price behavior of that. What is often looked at in these is calendar spreads between contracts. And the reason for that is that if we go to the forward curve, basically, and I'll go back to the prices, the spread between the calendar months is basically the steepness of the curve. And if you want to trade relative to how the curve moves, rather than having to be concerned about individual pricing, you do these calendar spreads as a part of that. So I go back here to this, and I'm going to add a position. And for example, I wanted to see the March D's spread. I bring up those two, I do the subtraction. And there is the March D's, what they call the March D's calendar spread. Let me check here. March, December, subtraction. Right, okay, we're good. And so we see the March contract is now trading. It's basically looking at the slope of that curve. It's trading $2.50 above the December contract. Relative to others, it's kind of on the high side. Let's push it out one more month to look at, say, the April D's contract, or what's also very popular would be the June D's spread. And I'll again isolate and just pick a few to get a sense of where it's sitting. And here is last year with the COVID crisis, the pandemic. I'll go back here to 16, 15, and so on. So we're sitting kind of in the middle of the pack. Now, what I can do is focus on this, say, from the beginning of the year, January 1st, to expiration. And I'm just holding the mouse key down and drawing a box around that data that I want to focus on or zoom in on. We were using the word zoom long before the meeting company came about, but that's another story. All right. Excuse me. Now we have it focused from January to expiration in in May, and this is the June contract versus the December contract, and we have this feature called absolute change, which allows us to set this at 0 for all the contracts as a way of comparing them and how they move. And so relative to the 2020, it's been very narrow. If I take that out, I get a little better sense that we do have some play in that, and that there would be opportunity if you believe it's going to be moving up, we're at the upper range and might create a new, or if you think it has the opportunity of moving down, meaning the curve is going to flatten out a bit, then you would see what the risk reward is by doing this kind of a manipulation. Now I've been doing what we call calendar spreads to look at the curve. What refiners worry about and what you can trade is the crack spread, the difference in price between the raw material, the crude oil, versus the finished product. In this case, let's do heating oil. And again, notice I'm just following the selection choices. I don't have to remember any code or any symbols. And I'll just stay with the December contract for both and do the subtraction. Heating oil price minus crude oil price would give us the margin on a one-to-one basis, so to speak. This is very simplistic, but at least it gives you an essence of the strength or weakness of the refined products, reflecting on the demand, reflecting on the state of the economy. One other adjustment I need to make is that since heating oil and gasoline are priced in dollars per gallon, and a crude oil is priced in dollars per barrel, there are 42 gallons in a barrel. I have to do just a simple multiplication to adjust it. So it's 42 times the heating oil price minus the price of crude oil gives us the margin. And so we have, at least for the December contract right now, the December heating oil crack. And again, I'll focus on that for a moment and bring in the others. And we see, again, it's in the middle of the pack. We don't have a good sense of where it might move until, say, August, for it's giving us a signal. And then I looked at it from absolute change. It shows what the opportunities. Now you might think, well, gee, this has already taken off. Isn't it going to mean revert? And the answer is we don't know. But what way we can measure this or adjust it and evaluate it is add a third leg. And we're not limited to 3 or 4. A user can create as many legs they want with all the various price the combinations they want to use. I'm adding a third one. And I'm going to divide out by the December contract. And what that does is it, so to speak, normalizes this heating oil crack spread relative to the crude oil price. Is the crack spread high because prices are high, or is the crack spread high because one was very low, in this case, the crude oil price relative to the heating oil price? And we don't know that unless we adjust it by one of the factors. In this case, I'm using the crude oil price as a factor to adjust it or normalize it. So you think of it this way as a spread, A minus B divided by B, to adjust for the values of B over the years. So there it is adjusted, and I'll go back and go compare it. And in this case, rather than being at the top, it's basically in the middle of the range. So if you think it has opportunity to go up, there is upward movement that it's done before, and or if you see have a bias that you think you would want to be on the short side, selling it, leaning on it to the short side, you have opportunity too with what happens, for example, in 2020. So it's an adjusted value, allowing you to normalize it relative to all the previous years. So they're comparing apples to apples at this point. Okay, as you see, we've created quite a few tabs. I could have named each one of them, set this dashboard up, save them all, and then as I would return to a session, I could bring them up automatically or one by one. It's all set up as a kind of a private individual library of data and information that you might want to follow regularly. All right, lastly, why don't we talk a little bit about analysis and actually come back to more of the fundamental data. As I said, what we mean by analysis is the merging of prices with fundamentals. So I'm going to, again, stick with crude oil for the moment. And stay with analysis. And goes to what we call time series. I'm going to stay with crude oil, continuation, just the front month. And under the fundamentals, I'll go to the DOE. Bring up the crude oil again. Stocks that we talked about before. Now when I plot this, we get a plot where the left axis is the price of crude oil, the white line, and this infamous spike down back in April 20th, Monday, April 20th, I remember the day quite well, where crude prices went to negative $40 and because of the issues there. And correspondingly, we have the crude oil inventories. And it's no surprise that we tend to see an inverse relation between the inventory level and the price of crude. But what I'm doing here is having a price chart with a fundamental chart. So I'm looking for possible correlations or signals that the fundamentals may offer me when I'm trying to understand what prices are doing and where the setting is right now. Also, let me go back to fundamentals. I had mentioned before that we have data on rig counts through the Baker Hughes. We have data on the CFTC. I should also point out that we are now a source for API data from the American Petroleum Institute, where our system acts as a front end to visualize the data that they support. That's a separate subscription through the API through us, but we do have all that data, which basically can be compared to and complements the Department of Energy data. But I'll speak for a moment on the CFTC, the commitment of traders. I'll go to the energy. Excuse me. Go to crude oil again. And we'll use the NYMEX contract for commitment of traders there. And we can do total open interest. Once it's finished weekly, we click on plot data. And this is total open interest in the crude oil contracts. I'll go to the time series again. And we see it had spiked, total open interest, back when prices were high, came off with COVID, it's coming back up a bit. And back in 2018, we saw $70 crude, so there was a great deal of interest at that time. I'm going to go back though and manipulate this a little bit by adding another position. And instead of total open interest, I like to look at non-commercial longs. That's the hedge funds and their long position. And I go here and do the hedge funds and their short position, and take the difference between the two by subtracting the first from the second. So, excuse me, the second from the first. So it's the net position of the funds long minus shorts, or net position, by taking this subtraction. Again, it's not completely obvious what it's telling us here, but what we'll see, excuse me, is how this tracks, the net position of funds tracks the prices of crude oil, and how it influences the prices of crude oil. So I go back here. I want to actually get out of fundamentals. I want to do analysis. Go back to the time series. And again, the price of crude versus now CFTC, the net position of the funds. And I do have to go through and reconstruct it, and you do it one time, you save it, and then it's done forever. So I want the late 9X, non-commercial longs. Oh, I want to take the subtraction and the non-commercial short and take the difference. So like before, this is the difference between the longs and the shorts, the net position of them, now against price. And again, this is interesting in that they really do track each other. And it's the case here. All right, the white line again is the price of crude, the March contract. And the red line is the net position of funds. Probably what I need to switch from is, instead of using the March contract, just to use a continuation contract for crude oil. Month 1, front month. And now, so this is your continuation price of crude. This is your net position of the funds in crude. Basically, the hedge funds, the large non-commercials. And they have a tendency of extending a price move, or depressing it by their movement in and out of the position that they have. And recently, they had kind of come off. They're not quite sure, because it had been uncertain for quite a while, since this last summer, what the limits were of crude. Now with this strengthening of the price, we're going to see them adding to it. And as they add to their net long position, that adds support and pressures prices upward. There was one other point I wanted to make. Oh yes, we could do it this way. I'll duplicate this. And instead of time series, we have a system called series. And I'll go to, let's see what I'm going to do. Continuation of price. Take this off. I want to add a position. Go to the fundamentals. Go to the CFTC and reconstruct those pieces. And we want the non-commercial longs. And then we repeat that. take the difference. And I could also add, say, a third position. Let's say we also wanted to plot this against fundamentals, the crude oil inventories. And the stocks. So I have three different items. I have a price, I have a net position of funds in the hundreds of thousands, and I have fundamentals in millions. So it would be very difficult to plot all three on the same graph because the magnitudes are so wildly different. So if I plot this and take off this point for a moment, we see down here is the price of crude oil, but relative to these hundreds of thousands, or millions actually, it's negligible, the value of it. The blue line is the net position of the funds, and the red line, the orange line, is the, that's the net position of the funds, and the blue line are your stocks, crude oil stocks. But if we really wanted to compare them, we can normalize their values, and we can get well, they're normalized in the notion of a 0-1 distribution for each one of the values, because we're taking the mean, subtracting the mean, dividing by the standard deviation to get their normalized value, a 0-1 or a z-score, if you might call it that. And we're looking at the issue of whether not so much the value influences one or the other, but the direction of the value, how they're related. Do the funds in their trending and trend buying exacerbate moves, or they tend to be lagging behind and end up getting hurt because they're staying too short, too long, or too long. They stay too long on long positions and don't get out. But the point again being is that this is fundamental data and price data all merged together on one system to look for possible relationships and ideas about the market. Now, we opened our discussion with how are we set for this year, and it looks like it's pretty good. We have good stock levels. Let's see, excuse me here. This is production. I want gasoline. Gasoline stocks are manageable, as well as heating oil stocks. Now, if demand picks up dramatically, and let's look at gasoline demand. So total, where are gasoline? Here we are. We want demand for gasoline. And we'll use commercial. Oh, I need one more choice where I want it, what part of the country or the total. And we see here that demand chart, it really took a hit back in the spring, where demand just collapsed for gasoline. It's been coming back up. I should add here that this is what we call noisy data because of the weekly changes, and you have a way of smoothing it, the four period moving average. Click on that, and we've smoothed it out to look for underlying trends this way. I should have noted earlier that all of these charts, besides having the data available that's behind the chart, you also have the opportunity to create hard copies of anything that you're looking at. So if I clicked on this and say pick the JPEG image, it will generate a chart looking like that, which we call, presentation quality chart. You might want to do a little editing of it, but otherwise it's well set up for adding. This is a JPEG, so you could include this into a document. If I wanted just a straight PDF version of that chart, I click on the PDF. And where are you? There we go. So there's the PDF version of that smooth data. Again, it's fast, it's easy, the presentation quality is sufficient for any kind of demonstration or discussion you want to have using this hard copy of data. Lastly, I want to point out that we're looking at the fundamental data of crude stocks and the others that came out earlier this morning. I want to show the overlay. Just all the data. This is immediately available on our system within seconds after the numbers are released at 9:30 Central Time. We also, at the end of the day, provide a kind of summary and some discussion, excuse me, of the numbers, which is sent out, which you can certainly request if you find this useful for your work. This comes out after the markets close because we like to include the price action that we have with the data. So we wait for the market to end before sending this out. But it's a PDF of the discussion of the data that occurred. And so we will be updating this shortly and sending it out, as I say, after the market has ended today. And as part of our system offering support and information for all our clients regarding fundamental data. This is only just a select few of the charts, but also price behavior that was happening leading up to and including that day. So that pretty much covers. I wanted to provide an introduction to how our platform works, what data it has, how to navigate it, and also the send-outs that we offer, part of the subscription to our clients. And we'll open it up for questions, should there be any. Andrew?
Joel, thank you very much. That was a fascinating presentation. As I mentioned to you before the session, I used to watch crude oil very keenly when I was more focused on futures many years ago. So it's great to see kind of the advancement of analysis here on spreads and correlations and so on. I just typed into the chat panel. If anybody's got any questions, please to put them into the question bank there. And I just want to see if we got anything coming in. And looks like not at this moment, but okay. So I wanted to show the attendees where. So I'm just going to take back change presenter to me, and I wanted to show people how they can see this in Trader Workstation, or at least how to subscribe using Trader Workstation. So I have my Trader Workstation up here on the screen. If I go to the upper left, you'll see there's a new window drop-down menu, and come under Information Systems and Analyst Research. The area is split into two: available subscriptions and items that you're already subscribed to. You get a tremendous amount of data to which you are subscribed by license when you open your Interactive Brokers account. So Joel's Fundamental Analytics service is under the available. So you click on the Fundamental Analytics Corporate, and it's going to tell me that I'm going to require a subscription, and it's taking me to log into Client Portal. When you go into Client Portal, you're going to go to Settings, User Settings, and Configure to request that service. I'm going to X out of there. And so if I'm on any page on Interactive Brokers, just to learn a little bit more about fundamentalanalytics.com, have a look under Pricing, Research and News, and then scroll down. You'll see here we have all, then what's available under the different kind of what's available essentially. I'm going to click on a la carte subscriptions, and then when you can see it under the show all, it's positioned under fundamental research. And then if I scroll down, you'll see right there fundamental analytics, and explains the fee structure and how to well, click here to learn more. It's available under IBKR Pro, and it is a third-party tool. I click on Learn More. It's going to take me to the microsite for fundamental analytics on the Interactive Brokers website, and tells you exactly here what I just described. Log on to Client Portal, select Menu, Settings, User Settings, Research Subscriptions, and then use the gear icon to configure your current subscriptions, and select Fundamental Analytics. And you can also link, we also link out here to the fundamentalanalytics.com website, and there's a sample report there that Joel has provided. So I'm just going to go back to see if there are any questions, and looks like not. So Joel, thank you very much for doing a thorough job. Remind us again, Joel, please, your website, if people want to get in touch with you and get any of those reports you mentioned.
Right, right. The website is fundamentalanalytics, all one word, .com. And to contact me, I'm at joel.fingerman@fundamentalanalytics.com. And happy to supply you our regular sendouts should you be interested.
Excellent. Joel, thank you so much for joining us today and taking an hour out of your lunchtime to explain to us all about your services. We really appreciate that. And is there one other question coming up here, or are my eyes deceiving me? So Andrew C asks, beyond energy complex, how broad is your coverage of other futures? I'm not sure that you do anything other than energy, Joel, is that right?
No. What we have, let's go here. We have agriculture with all the commodities there, the energy commodities, financials, and metals in this case.
Okay, I stand corrected. So energy, financials, and what else was it, Joel?
Agriculture.
Agricultural commodities. All right. I hope that answers that question, Andrew. What about lumber? Lumber, is that
lumber?
Probably.
It's we're not carrying it specifically at this time, but we're looking into that because we have had more requests for it.
Okay, looks like there's another one coming in there from Andrew C specifically for that. Okay, Joel, thanks so much. I'm going to end the session since we're running up against the 1 hour mark. This session will be available on the Interactive Brokers webinars, previously recorded webinars page. So that would be under, let me just show you all where to go and have a look at that. So you can pick this session up if you want to watch it again later. Education, webinars, scroll down, view previously recorded webinars, and then select the scroll down once more, industry sponsored, and we'll have that up and running later this afternoon. You'll be able to click on that and watch the rerun if you want to watch that again. All right. Thanks, Joel, and we'll speak to you next time.
Thank you, Andrew. Appreciate it. Thank you. Bye-bye.
You're welcome. Bye now, everybody.